TDS or tax reduction at source was initially introduced by Income Tax Department. It involves reduction of certain percentage of amount at the time of making payment. It acts as a powerful instrument to prevent tax evasion and expand the tax net, as it provides for the creation of an audit trail. Under GST, the following persons have to deduct TDS: a department or an establishment of central government or state government, or a local authority, or government agencies, or such persons or categories of person as may be notified the government on the recommendation of the GST Council. The tax would be deducted at the rate of 1% of the payment made to the supplier, where the total value of such supply under a contract exceeds rupees 2,50,000. This excludes the amount of central tax, state tax, union territory tax, and integrated tax and cess. What is important to note here is that the contract value has to be seen. Thus, individual supplies may be less than rupees 2,50,000. But if contract value is more than rupees 2,50,000, TDS will have to be deducted. However, no deduction is to be made if the location of the supplier and the place of supplier is in a state or union territory which is different from the state or union territory of registration of the recipient. The reason for this is due to difficulty that will be faced in transfer of TDS. Let us consider the various situations and try to explain this state. Take the first case where supplier, place of supplier and recipient are the same state. Right? So supplier and receiver are in the same state. It would be intrastate supply and TDS will be deducted. So will be CGST and SGST will also be deducted. It would be possible for supplier, that is deductee, to take credit of TDS in his electronic cash ledger. Take the second situation where supplier as well as the place of supply are in the different state. In such case, IGST would be levied. TDS has to be deducted, would be TDS of plus integrated tax, and it would be possible for the supplier, that is deductee, to take credit of TDS in his electronic cash ledger. Take a third situation where supplier as well as the place of supply are in the state A and the recipient is located in a state B. The supply would be interstate supply and central tax and state tax would be levied. In such case, transfer of TDS, CGST plus SGST of state B to the cash ledger of the supplier, that is CGST plus SGST of state A, would be difficult. In such cases, TDS would not be deducted. Thus, when both supplier as well as the place of supply are different from that of recipient, no TDS would be applicable. TDS deductor has to compulsorily register without any threshold limit. Ordinarily, PAN number is compulsory required to register under GST. However, a TDS deductor can obtain registration using his TAN number, that is your tax reduction and collection account number issued under the Income Tax Act. The amount of tax deducted at source is to be deposited to the government account by the deductor by 10th of the succeeding month. A TDS certificate is issued by the deductor within 5 days of crediting the amount to the government. Let us take the example of a supplier making a supply of furniture worth 20 lakhs to central government department. GST rate of 12% is required to be paid. The recipient, while making the payment of rupees 20 lakh in June to the supplier, shall deduct 1% of 20 lakhs, which is 20,000 as TDS. The value for TDS purpose shall not include 12% GST. The TDS so deducted is to be deposited in the account of government by 10th of the succeeding month, that is July.